Good morning, everybody. Welcome to the Mortgage Coach Friday Mastermind. Every Friday, we are here to bring authors, leaders, top producers, people that can help you be more successful. Like the name of the Mortgage Coach Facebook group is Mortgage Coach Productivity Mastermind. How can you be more productive? How can you be more successful? And today we have Todd Ballenger for part 2 of Money Management for Loan Officers. What's up, Todd?
Hey, glad to be here as always.
Good to have you. So we don't have Mr. Win by Noon today. Todd is at the New Orleans Jazz Festival. So anybody in Mortgage Coach land, if you are at that event, be looking for Todd. Say hi to Todd Bookspan. Maybe he'll be wearing a Win by Noon shirt. I don't know. Deborah, what do you think? What do you think the odds are that Todd is wearing a Win by Noon shirt today?
100%. He's probably wearing the hat and the shirt with like a little, because he's always cold. So probably even a little, long sleeve jacket too.
Oh, that's funny. Yeah,
You're not a winner unless you sport a Win by Noon shirt or Mortgage Coach shirt. So y'all don't forget to go to the Win by Noon store and get your gear and represent.
Yeah, we'll put a link down below, but no borrower left behind, logos of both Sales Boomerang and Mortgage Coach. And guys, I get asked questions daily would be an exaggeration, but weekly, multiple times a week, I get like mortgage questions. Oh, you loan officer? What does that mean? What is Mortgage Coach? What is Sales Boomerang? So represent, link down below. Deborah, anything you want to say to frame today's call before we bring Todd on stage?
Yeah, just that, today is the last business day of April. So don't forget to go back, review your activities to see what results that you got, what adjustments you need to make, and then also use today as your reminder with your clients that it's also the end of the month. So I'm sure Todd will go into this possibly a little bit where they too should be printing out their statements, reviewing where their income is going, how much is going towards housing, utilities, whatnot. It's just a good time to reflect, especially when inflation is as high as it is, and it makes for easy conversations for y'all to get on the phones and connect with your database. So take action.
Great. And I want you to think you have 2 roles today. You're Mrs. Win by Noon. So you do the wrap up at the end like Todd always does.
Oh boy, pressure.
Yeah. And then of course you're also plug and play SM. So I do think, one of the goals here is to provide some financial literacy lessons, but maybe, pull up some social media images that align with some of the lessons Todd's teaching, and like, how can we take this lesson from Todd and how can we put it on social media? So be looking for that.
Okay.
All right, guys. Well, let's get after it. Again, this is part 2. We'll put a link to part 1 down below. So if you're watching this in YouTube, there'll be a link to the first hour we did on this. But Todd has a financial literacy training program, and we did this from the lens of teaching loan officers. Like, if you're going to be a leader to others, you need to know this for yourself. So the whole kind of the voice of today's lesson is, hey, loan officers, go through this process, learn these principles, reflect on what they mean to you. And then part 2, which that's not even today, but in his other training, it's like, now how do you take this to the market? So Todd, jump on stage, and where do you want to start, brother?
Well, I'm choking myself to death. We're going to start where we left off, I guess, which is an interesting topic that some of you are familiar with, that being debt and borrowing. So I tell you what, if you want, I'll share the screen here, and we'll just use it as a talking point. And, you guys jump in, play with me here, but we could talk for hours about just borrowing. Obviously, that's where we've sort of made a market over the years. And when you think about borrowing, a lot of us are in the business of lending money, and we've never really thought about, what is borrowing, what is lending, what's the difference between borrowing and investing. Things like that. But let's just kind of keep it simple to start with. When you borrow money, you have the ability to spend that money right now. Think of that as pulling your future forward. Anytime you borrow, you probably have heard a lot about the Fed, right? Printing money, Dave, like the Fed's printing money, talking about the money printers or rent, when you borrow money, you create money out of thin air. It didn't exist until the moment you borrowed it. So when you borrow for a house or whatever, you have the ability to spend that money right now. What people don't often think about is what they've really done is they've pulled their future spending power forward now to be able to use it today. But there's a cost to that, right? Because you got to pay that back over time with interest. So we're going to talk about good debt and bad debt, but I want to say right up front, if you think about your future self, at some point, your future self probably is going to like money as much as you do. So when you're thinking about borrowing, if Deborah sees a sweater and she says, oh, this is an awesome sweater, I love it, and it's $80 and I don't have the money for that right now, I'll just put it on my credit card, right? If she uses a credit card for convenience and pays it off at the end of the month, she gets the points and, you know, all that kind of cool stuff and helps her credit. But if she doesn't, right, then she's now pulling that spending power forward from a future self, meaning she's not going to pay $80 for the sweater. She's going to pay $80 for the sweater plus the interest on that sweater. And that's just something you have to think about. What's interesting about housing is it's really the only form of borrowing where you can borrow from your future self and enrich your future self at the same time. If you think about it, most assets depreciate, cars, just about everything, with the exception of maybe student loans where you're bettering yourself and increasing your potential for earning in the future. The house is one of the few things that historically, I mean, all the way back in time, has gone up in value. So when you're borrowing from your future self, you get the benefits of housing today. And while you are taking money away from your future self in the form of having to service that debt, the asset itself tends to go up in value. So that's one of the reasons we say it's one of the key forms of what I would call smart borrowing. But if you think about your future self, it's kind of helpful sometimes as just a core lesson. And we talked about in the first lesson, the 3 buckets. Anytime you borrow, you create a 4th bucket because that bucket is going to, it's the money's coming out of it into your current bucket to be spent. If you buy a car, you do a loan for that car, you're taking money again out, putting it in a bucket to buy the car or whatever, and then you're going to pay that debt back with interest over time. So what do I think of as bad debt? And again, I'm going to go off on a little tangent here, but when I've had a lot of loan officers who reached out to me about, you know, facilitating, and I use that word instead of teaching. Teaching implies that you're going to teach someone something. Think of this as facilitating. If you want to go into high school or you want to go in and do this yourself, you can just go in and walk through these slides and just point out key concepts and encourage people to learn more. It's not like you're having to teach them every concept or idea. You're just exposing them. You're opening up folders in their brain that maybe they didn't know they needed to have, right? And you're just explaining to them that bad debt is, you know, credit card, personal loans, and payday loans. Why is it bad? Well, because it tends to purchase things that are depreciating and the interest rates tend to be very high. And that's a bad combination because you're going to pay more for it over time. And the asset you're buying is probably not going to be worth what you paid for it at some point in the future. So if you're going to have bad debt, credit cards are wonderful for convenience, but they're not an antidote, right, for not having money. That's just going to make you have even less money in the future. You know, personal loans, family loans, payday loans, things like that. Those are not really good debt strategies. Neutral things can be like auto loans. And I say neutral, I used to look at them as bad debt, but nowadays you can get 0% auto loans, which dramatically reduce your cost of ownership of a car. And of course, the longer you keep a car, the more value it has for you, because once you drive it off the lot, if you do a lot of studies, you know, the ideal time to buy a car is 2 years old off of a lease, because you're getting the most value. Someone else has taken that hit for the depreciation. But still, you can get interest-free loans these days on 2- and 3-year-old cars and get them financed over time, allow inflation to depreciate the debt, which we'll talk a little bit more about. So when you're thinking about, you know, this sort of, you know, neutral debt, you know, you can always pay cash or you can pull some money forward from your future self and borrow for that car now and know that you'll be paying that car off over time. But then what's good debt? You know, and what's the difference between good debt and bad debt? Well, good debt tends to be lower interest rate. And it's anytime you buy what you think of as an appreciating asset, like you just shared, Dave, an interview did with someone about Elon Musk and him using leverage, right, to buy Twitter. He's doing that because in his mind, he can get a fairly low interest rate and he's going to buy an appreciating asset. And anytime you can do that, you're back into this something that we've talked about before. Anytime you borrow money, there's two reasons to borrow. I have to, that's necessity, and I want to, that's opportunity. So I want to borrow money because I could pay cash for my house, but I want to have that money somewhere else earning a higher return. I've got a better use for that money versus I have to borrow because I have no other choice. If you have to borrow, good debt is the way to go, and avoid the credit card and the high interest rate debt whenever you can. So let me just stop there, take a breath, see if you have any questions or thoughts.
Let's pull down the slides and just have a little fireside chat on this, what you've shared so far. Deborah, anything you want to ask or comment on?
Well, the first question I have, and this is just selfishly help me with creating, more valuable content, would be what are ways, how could the good debt, say equity, that's, or a mortgage, what do you think are some missed opportunities right now of how people aren't leveraging that to maximize those appreciations where they could use that debt as now an investment vehicle?
Let me see if, so one thing that I posted just yesterday on the loan to values and stuff is if things move in cycles, houses move in cycles, markets move in cycles. We're coming off of an all-time high in the stock market, and we just had our first negative quarter, which means, it takes 2 negative quarters to put us in a recession, to officially be in a recession. We won't know that until 2 quarters have passed. But now we know the first quarter is in the books. So we could be already in a recession, moving into recession. We see interest rates going higher. I've seen Freddie Mac studies that say when interest rates go up, housing prices come down anywhere from 8 to 20%, right? So that's just an asset that you own. What could you do with that asset? One thing I recommend is an equity line of credit, because if you get an equity line of credit now, you can have access, use, and control of money in the house, even if the house value drops. But think you got a house worth $300,000. What if it was worth $200,000 in 2 years? That would kind of stink. You've lost $100,000 in borrowing power. If I had an equity line of credit based on that $300,000 value, even if it's to 70 or 80%, I could still have access, use, and control, which is called liquidity, of that asset if I needed it. If I was going to do a reverse mortgage, I'd rather do it now than in 2 or 3 years when the house value might be $100,000, $200,000 less. So you have to think about, what's the highest and best use of my money. If I had a house, I've talked to people that bought a house for $500,000, it's worth $1 million now, right? In 2 years, it's gone up $500,000. If you had a stock that went up $500,000 in 2 years, you might think, gosh, I'd like to take a little risk off the table, right? Now, if I was a stock, I could just sell the stock. A house is a little different. If I sell the house, I don't get to continue to use it. So then my choice is to borrow, right? And say, okay, I'd like to take 200,000 or 300,000 of that equity gain out of the house and reallocate it somewhere else, maybe into something that I think has got the potential to appreciate more over time. Or maybe I just want the liquidity, right? That's where you get into sort of mortgage planning concepts and stuff, to think of your house as an asset that's part of your overall portfolio. Most financial advisors, I was talking to a loan officer earlier this week who said he's been out meeting with financial advisors. He's doing our course, and he was really surprised that financial advisors don't count real estate as an asset on most of their financial planning models that they create. Wow. And the reason is, well, you're always going to need a house, right? Which is true. But that means you're missing all of the planning concepts you can do around owning a house and borrowing and debt, and everything from consolidating debt to leveraging, taking debt out, and using that debt out of one house to go buy a rental property. I mean, there's so many different things you can do, but they don't even think of it oftentimes as part of your retirement and estate.
Hey, I wanna go through a couple TCA samples that came up. I mean, we're talking, this is yesterday, guys. So this is a life in the day of Dave Savage yesterday. Sean Herrero saw that news with Elon Musk buying Twitter and how they financed it. The fact that he didn't buy it cash, he used leverage, and he used it as an opportunity to do a lesson, little micro lesson. And it's actually on YouTube. It's 6 minutes. At about 2 minutes and 45 seconds, he actually pulled up this total cost analysis that I'm showing you right now. And he used this to teach his lesson on leverage. And, he was, like, hey, here's rent and keep your money in the stock market. And here's multitasking, basically buy a house with a minimum down payment, put what's left in the stock market. And, look, in 5 years, you've got $250,000 in net worth versus 70,000 in net worth. So just, this is how he did it. He walks through it in detail in my interview. I also did a special training for movement. And I told all three of them were $100 million producers. All three of them were grandmasters at Mortgage Coach. And I asked them to do a little micro lesson or not teach, like, what TCA do you want to show? And this loan officer decided to show this, where, it's the power of, leverage and the power of different strategies, investing. I thought that was super interesting. I don't have time to go through this lesson right now where he did, 50% down because that's what the customer thought they wanted to do. And then he showed a 20% down, and then he showed a 10% reinvest. And he showed that, hey, you came to me wanting 50% and big bank said yes. You had a strategic conversation with me. And he showed him how, literally we're talking, over 15 years, this is $1 million decision. I'm going to show one more and then I'm going to open it up for you. When Shant Badoshian, #1 loan officer in America, started adopting Mortgage Coach, one of the first TCAs he started doing was down payment options. Because he's like, hey, a lot of people want to put 20% down. That's what big bank tells them to do. That's what most loan officers tell them to do. And then he, showed a 10% down, a 5% down. And, when you invest the difference, like, it makes sense. This was just over 8 years. He showed the family a 5-year pro forma, and then he showed them an 8-year pro forma. So one last one, and then Todd, I'm going to open it up to you. I think in this market, everybody should be doing either a, Jeremy Forcier, right size your home TCA, or a move up. But again, another example where, hey, keep your current home, refinance. By the way, this is a little dated, so, this wouldn't even make sense now. But hey, purchase a bigger home, about one extra bedroom, one better, little bit better school district, and either sell your home and put all of your down payment into your new home and get your lowest monthly payment. And sometimes that monthly payment is lower, or buy the new home, have a higher monthly payment, but look what that does to your net worth. It's all about leverage. And so, Todd, any thoughts you have on any of these examples I just showed?
Yeah, any of those. Scroll down to the bottom of any of those, and let's just talk about one really important, we'll call it money concept.
Hey, let's do this one just because this is so real world.
Okay, yeah,
so common. Where, like, who doesn't do a down payment analysis?
Yeah. So when you think about, we talk about working with financial advisors, and there's this thing called the three-legged stool. And this is something you want to keep in your mind anytime you're thinking about money. You've got a leftover dollar at the end of your month, and you've got something you can do with it. And the three-legged stool is safety, liquidity, and return. How safe is my money? How liquid is my money? And what's the return going to be? And think about it. If you've got, let's just say you've got an extra dollar at the end of the month and you want to put it in a checking account. Well, is it safe? Pretty safe, right? The bank's guaranteeing it. The FDIC is insuring it up to $250,000. That feels pretty safe. How about liquid? Absolutely, man. I can get access to it. I can write a check on it. I can use my debit card. How about return? Not too good, right? Not almost 0%. You're losing money keeping it there because of inflation. So there's the old, price, service, value, the old thing, you can pick one or two. It's the same with investing, same with your dollar. So in this case, if you've got $100,000 to put into a house, and you're going to put down 5%, 10%, or 20%, it's the same question. If I put 5% in my house, how safe is that investment? All right, versus 10% versus 20%. Those are just numbers. And these numbers are focused on return. And that's one of the cool things about real estate is there's leverage. So you're getting a multiple. The less you put down, the higher your effective return because of leverage from a return perspective. But this is focusing on return. Ask yourself about the other two legs of this stool. Where's your money going to be safest? And safety is about risk of loss, meaning am I putting myself at more risk or less risk in this situation with a 5% down payment, a 10% down payment, or a 20% down payment?
So think about it, guys. This particular scenario, he used 4%, so a very conservative number. I mean, 5% is considered conservative, and there's a lot of folks earning over 8, but 4. And so everybody tell me, is this family's money, if they're just shooting for 4%, is it relatively safe? The answer's pretty safe. Is it liquid? Well, it's very liquid. I mean, unless they're putting it someplace they just don't need to be putting it, it's liquid. And then are they improving the ROI of their down payment? Oh, absolutely. If the house is going to appreciate their return,
hold on. Yeah, go back to that because I want to finish out. So the safety I'm talking about is who is safer with a 20% down payment? You or the bank?
The bank.
Who is safer with a 10% down payment? You or the bank?
Me.
Compared to 5, right? Compared to 5, the less money you have tied up in a house, the more the problems are the bank's problems. The more money you locate in the house, the more the problems become your problems. If you lose a job, have an issue or whatever. So that's from a safety standpoint, you want to think about who am I making safer? If I put 50% in a house and borrow 50%, I'm pretty much guaranteed that lender is never going to lose money, but I'm still at risk, right? If something were to happen, if I get sued, if I get, can't make the payments for 2 months, there's all kinds of things that can happen there. And you're spot on with the liquidity. The only way to get money out of a house once it's in the house is to borrow or sell. How many options do you have to get money and access, use, and control of money if it's somewhere else? Well, that depends on where you put it, right? But in most cases, you don't have to borrow it and you don't have to sell the asset to get it back unless, it's a stock or an investment, but those are incredibly liquid. So these examples are awesome for showing the net worth impact, but at the back of your mind, also be thinking when you're talking to your clients, who do you want to make safer, you or the bank? Because if you want to make the bank safer, the more money you put in, the more protection you're ensuring for that particular entity.
So I do think while, we're teaching money management for loan officers, I think this lesson is really going to help you guys when you have families that are, looking to put all cash down, or families that are looking to put 50% down. And I can't tell you in the interviews that I do with top producers, how often the biggest way that they're winning that loan and they're getting the trust and the conversion is to help people broaden their scope. Most people just think like, put 20% down, no MI. My goal is to put 50% down. And remember, just a little bit of education. You're not here to sell money or convince them, sell them something. You're there to give them an informed decision. And there's no better way than a total cost analysis, whether, put in column A, cash, and they have no mortgage, they have the home, put a rate of return that they're getting on that cash. And then number 2, put in 50% down. Like, hey, what if you really put a lot down and you had that security, you had that, whatever that you think that means to you, what's your net worth look like? And then put column 3 that, and maybe for a cash buyer, they're not going to do 10%. Maybe it is cash, 50%, 20% down. But whatever's tailored, this is something that can really help families build wealth with real estate faster. And you know what else, guys? This is the kind of conversation that financial planners and CPAs want their loan officer having with all their clients. So if you can show a CPA and a financial planner that this is the process I go through in lending money, they're gonna like that. You're gonna be very unique to them. You're gonna be very valuable to them. Deborah, anything you want to add on this before we hand it back to Todd?
Well, it's so hard for anyone who's worked with consumers on getting them to understand is that if you're not showing them the total cost analysis where it shows the proof in the numbers with the charts, otherwise it's just so hard for people to understand, why wouldn't I put more down on a home? They think that's the safer option just from their, conditional thinking of it's a lower payment and I'm going to be safe with being able to afford the home. They just don't see the opportunity cost because most lenders don't show the cost over time. And that's why, kudos to your shirt, Dave. Most people, they don't go to a financial planner until they have wealth. And so we have a lot of people who are in debt and they're just trying to make it month to month. And so from a loan officer standpoint, it's such a massive opportunity to get in front and teach these lessons through the TCA, where then you're actually helping them create that wealth. And then you're handing it over to a financial advisor where, those who are going straight to the financial advisor, I mean, at least they have something to plug into and to create, a rate of return. Otherwise, people who are getting the mortgage, you're the first one. So be the captain of the wealth team and use this, and, don't keep it a secret either. So if you have a great TCA or example like this, make sure you're also going one to many, or you're doing a realtor presentation and you have these printed out and, or going and meeting with financial advisors. Don't be the best kept secret.
And I can't emphasize enough, guys, with what you've just learned from Todd in this conversation. And if you watch that 6-minute video that Sean did, everybody in the mortgage coach community should be creating your own version of leverage. And hey, what every home buyer can learn from Elon Musk acquisition of Twitter. I mean, there's all kinds of great ways to news hack off of that article and then talk about the power of leverage for home buyers or people that want to build wealth with real estate. There's just a lot of ways of doing that. So I am going to give that as a homework assignment to everybody in the community. Re-listen to what Todd just shared and, use safety, liquidity, ROI. I guarantee Sean, if Sean would have listened to this before he created that, he probably would have tuned up what he said a little bit. And here's the other thing, guys. I put a link to the No Borrower Left Behind shirt. So I would love to see some folks making some videos, spreading financial literacy and representing the No Borrower Left Behind movement. So check out the link. Todd,
Can I just say to that, Dave, real quick, that a lot of loan officers will say that they help clients build wealth through real estate. And I believe a lot of them do. But if you're social proof, which is your street cred, that is the new, when people drive by, are the lights on in your building. If you're not consistently posting, then people create these stories in their head and they may go online. They're like, oh, well, maybe he got out of the business. I know rates have gone up. And how else can you control the narrative than with your social? But the key is you have to have a strategy that proves your words, because talk is cheap now. There's 5,300 posts every single second. It's very noisy. So how do you prove consistently every week that you are the loan strategist, that you actually help people build wealth? If you're not doing a TCA at least one time a week, those of you who are doing my 75
TCA mini.
challenge,
That's TCA mini once.
yes. Well, that's what I was gonna say. The TCA or the 75 hard challenge that I posted in the group, the 75 hard workout challenge, you do 2 workouts a day. Well, for the social media challenge, I said 2 TCAs a day, and one of them has to be one to many, where you're showing like exactly what Todd just showed of how he analyzed the net worth. That's a micro clip that could be a reel or a story that again is going to position you the moment someone drives by your storefront, see if your lights are on, and they're going to make their judgment about you, which they always make 2 judgments, warmth and competency. Do you show that you're different than any other originator who just has the typical vanilla loan product type post? Be the strategist, show the problems you solve, and prove your words each week. And the TCA makes it super easy.
All right, guys. So remember, if you have questions for Todd or for Deborah and I, put them in comments while this is live. And if you're watching the video on YouTube, still put questions down below. We got 29 minutes. So Deborah, let's let Todd really run through these slides. We want to make sure we cover everything he wants to share in this part 2. And then we'll save comments for the end. I mean, if we do want to jump in and add something, do it. But Todd, you think 30 minutes is enough for you to get through the rest of what you got?
Yeah, we'll hit some real kind of the key highlights. And again, this is same thing. You know, we're just creating some awareness here. I would encourage you to all go deeper with this stuff. Learn how to communicate what it is that you start to learn, and that just takes practice, right? Getting out there and understanding that people live lives of cash flow. And when you're talking about a lot of these concepts, you're always having to overcome that, okay, but if I just put a whole bunch more down, I'm gonna have a lower payment, right? And that's really what they want. They're missing out on the huge implications, the wealth impact and things that some of these decisions make. And you can learn how to overcome that. You know, credit is something that I love talking about. It's an interesting thing. I like to call it the game of credit, and everyone's playing the game of credit, whether they realize it or not. So having people just aware that they're playing a game, what that game is, it's a 3-digit number that manages risk and what it means. When you're sitting in front of, you know, your own credit score, at the simplest level, you know, think of credit scores as like house odds on a default, because all lenders, when they loan money, they do not want your asset. They want your cash flow, because they are going to securitize that cash flow and sell it. And the last thing they want is to have to deal with getting the house itself back. So they're underwriting you. And what the credit scores do is they give them an odds of what is the likelihood that you may default. For example, if you're over 720, the odds get pretty darn low. They're super low above 800. But you know, you get down in that 600 range, suddenly the odds get much higher, right? So how do you compensate for higher risk? You do it by saying, okay, if I'm taking more risk, I want a higher return. And how do I get a higher return? I have to increase interest rates. So the consumer is paying a risk premium. So the way we would say is, look, if you want to pay a risk premium whenever you borrow for cars, autos, even things like home insurance, all of these things now are indexed to soft pulls and credit scores. You're going to pay a tax in the form of higher interest on everything, but your largest expense is usually your house. So that means the largest tax will come in the form of higher mortgage payments. So you always want to play this game the best way that you can. It's a game where you play, if you're in a relationship, you play with your spouse or significant other or partner, and the low score is unfortunately the score that the team gets to use when they're playing the game. That means you can't play the game alone if you're you know, married or in a relationship where you're using 2 scores to borrow. A lot of people don't realize the implications of investments. Even when you're investing in certain things, credit scores are going to get pulled, because again, people are looking at managing risk. And your cost of home ownership on a $260,000 30-year fixed mortgage can vary by as much as $1 million over your lifetime based on your credit score, right? So this can be a really, really big tax. And 80% of Americans have at least one error. 40% of Americans are paying a higher mortgage payment than they need to because of credit scores. And 25% of Americans have credit report problems that would prevent them from even getting a loan to begin with. So it's an important game. And again, you're just creating awareness about 2/3 or more of your ability to access money, especially from a liquidity standpoint, is tied to your credit score. And there are a lot of misunderstandings. So these are things that don't affect your credit score. Your income doesn't affect your credit score. Your education does not affect your credit score. There are a lot of misunderstandings. Inquiries can or cannot, but these things do affect your credit score, right? So just walking someone through this process and talking about it and getting down to what are the kind of the key criteria and how do they become the rules that make up your credit report, payment history, utilization rate, length of time, type of credit, and their inquiries. As with most of this stuff, again, depending on the level that you want to go down the rabbit hole, this is a really cool slide. And we're going to go through the summary slides here in a minute, which are just the key concepts from each of these 9 modules. But this one's really important. If you've got someone who's wanting to make an improvement on their credit score, then make all your payments within 30 days, keep all your balances under 30%, keep all your accounts open for as long as possible, meaning even if you pay them down to zero, keep them open because they affect your length of history. Keep at least 5 active accounts at all times, and keep your private information private, meaning don't let everyone know your stuff and pull credit reports just because they want to, right? And so things like this can be helpful for you individually, and understanding that your credit does have an impact, not on just borrowing for a house, but on so many different things. Taxes, again, just walking through what are the 3 main types of tax: income tax, capital gains tax, and dividend tax. One of the key concepts to understand is we are in what's called a progressive tax system in the United States. And what a progressive tax system means is that the more you make, the more you pay on an incremental basis. You're moving into higher bands of taxation based on higher bands of income. So a lot of people misunderstand. If they make, for example, $200,000 a year, they think I'm in a 32% tax bracket. That would never happen, because you're paying 10% on this amount, then 12% on this amount, then 22, then 24. You're only paying 32% on the highest level that you achieve in terms of income. I think the average tax bracket that most people pay in the United States is in that 18 to 20% range, which means most of us are working till about May 1st to pay our taxes for the year. So this kind of a depressing fact, but it's just a reality that you're going to have a number of months you work each year just to cover the tax burden.
Hey, Todd, someone just asked if they could get these slides.
Yeah, well, they're all on our education site. So comeducation.com or go to Knife, but they're all there.
We'll put a link to comeducation.com, but these are free and available. Just follow Todd there, and there's a lot more content. He'll give you an overview at the end of what you can
and all the videos are there. Each one of these is about an 8 to 9 minute video where we're going through this, and you can freely incorporate and embed these on your website and create an experience for your clients if you want to do that. All of the videos are shareable, and we have a lot of loan officers that are just putting them right on their web pages. They're setting them up and then having a place for customers to come and just go through some of these things and learn. So income tax is progressive. Capital gains tax is a little different. When you go out and make money that's not ordinary income, if you make that money within a 12-month period, it's going to show up as ordinary income. If you have money that you made, say, at 12 months or longer, like an investment or stock. So if you buy a stock and sell a stock in a couple of days or a couple of months, you're going to pay income on that. It's going to flow through to your ordinary income. If you hold it over 12 months, you're paying a longer term capital gains rate, which is anywhere from 0 to 20%. And you can see based on your income here. So the first 40,000 or first 80,000 that you make is taxed at 0% if you're married filing jointly. So there's an incentive for you to invest and hold on to investments for longer periods of time versus trading. And this can be really important if you've got a highly appreciated asset that you've held for 11 months and you forget about this and you just go sell it and you realize, oh my gosh, I had a $100,000 gain. I've got to pay ordinary income on that. Well, based on a progressive tax system, if you were making $200,000 this year and now you got that extra 100,000, you just jumped all the way up into the highest tax bracket. If you just waited one more month and sold that asset, then it would have flown through on your capital gains and you would have had a much lower, in this case, an extra $100,000 would kick you into that 15% tax rate on that gain. So again, these are little things that most mistakes that you make financially, you make them by making them, and you have to. But if you can start to understand some of the key rules, like how capital gains works and how's it different than ordinary income and what's a dividend. And, a dividend is something you're paid. I love dividend producing stocks. One of the strategies that we teach in the book and in the course is that if you have a highly appreciated house, one of the things you can do is take that equity out of that house and put it into a real estate investment trust, which is a liquid ETF that pays a dividend many are paying right now 8, 10, 12% dividends. Now you're getting a steady stream of income that will offset that mortgage payment difference and create wealth for you and provide you liquidity, et cetera. What's cool about dividends is dividends are treated more like capital gains, especially if they're qualified. So a lot of the dividend income that you can receive is taxed at a much lower rate over time. So you want to understand the basics of, okay, dividends and how do they work and how are they taxed? Capital gains, we've got examples in here for you on that. I'm not going to try to explain it all because it's kind of hard to go through examples in the time we have. Qualified savings is really important because it affects taxes, and taxes are important. Death and taxes are always there. 401k, IRA, Roth IRA are the main types of savings. But in the prior class, we talked about the critical concepts of compound interest, money dynamics, rule of 72, the doubles and stuff that you receive in your life. They happen much faster when you don't have the burden of taxes. So with 401ks, IRAs, what's called a qualified savings plan, qualified means the US government, the IRS, has qualified this so that you can earn this income and have it grow tax-free until you retire. You will pay ordinary income when you retire. And there are lots of different rules of thought here. You could be in a lower tax bracket when you retire, and you could be in a higher tax bracket when you retire. In a weird way, if you pay higher taxes in retirement on this money, it means you did pretty good because you've got so much income in retirement, you're actually making more money than you were when you were working. And that's a true thing for some people. Or you could be in a situation where you control your income, you're not working in retirement anyway, the income's much lower, and you're paying a low income tax. But the key here is you're getting that opportunity for all that money to compound and grow over time. And one cool thing about a 401k, especially if you have one with your company or an IRA, is it reduces your current income. So if you make $100,000 and you contribute $10,000 into a qualified savings plan, that comes out in advance of you receiving your check. So the IRS says, hey, you didn't make $100,000 this year, you made $90,000 this year. Reducing your income by that amount reduces the taxes you pay this year, plus it gives you that bonus. And one of the big congressional acts right now is they want to make 401ks, enrollments, and contributions defaulting to automatic when you join a company and you have to opt out. That's a big behavioral difference right now, whereas they're available, but you have to opt in. It's not saying you have to do it, but they say that behaviorally, if they just set it up coming out of the gate in a way that you would automatically opt into all these things are good for you, you might, again, take a different behavior and just start when you're younger, because you don't miss that money when it comes out up front. You tend to live with the cash flow you have available. If you don't have a company 401k, you could use an IRA, which is another way to do this. And again, if you don't have a corporate taxable type tax savings qualified plan, I can put my own money away in an IRA and I still get to reduce that contribution just like I didn't make that income. So even though I was paid $100,000, if I put $6,000 in my IRA, then I get to show that I only made $94,000 this year. It's done automatically on most tax programs. If you show IRA and you put in the amount that you made, $6,000 or $7,000, depending on your age, that comes right out of your income. And I'll touch on Roth IRA only because what's cool about the Roth IRA is it's a flip. With a Roth IRA, you pay taxes on the money going in, but you don't pay taxes on the money coming out. So for some people, that can be a really big deal, right? Because a traditional 401k or IRA, you're not taxed on the seed, but you are taxed on the crop, right? And the crop is probably going to be a lot bigger than the seed. With a Roth, you're taxed on the seed, but you're not taxed on the crop. You get to take all the money out at the end, tax-free, but you have to pay taxes on the way in. So a lot of people are looking at Roth IRAs, and you've seen a lot of very smart people like Peter Thiel, who put his stock from some of his investments in a Roth IRA. They're now worth billions. And guess what? He can take all that money out tax-free because he did a self-directed Roth and put equity inside of that. So pretty smart tax planning. And again, once you start playing this game, you start to understand that there are some rules that you can bend a little bit when you need to. Last thing is inflation, and then we'll kind of look at the PenFin worksheet that is available to you if you're interested in sort of seeing how you're playing the game right now. But this has been a big topic, and I think people need to understand the types of inflation that are out there, demand and cost and things that are built in. And we have historically, outside of the 70s, lived in a period of extremely low inflation. Well, we've just seen that change, right? We have just shot back up into the 8 to 9%, 10% inflation rates that we haven't seen since the 1970s. This is the most important concept I believe to understand about inflation is it's all about purchasing power. And we said people live lives of cash flow. So if you make 5% more this year than you made last year, and inflation is 2%, you feel like your income has gone up by 3%. If your income goes up 2% this year and inflation is 2%, you actually don't feel like you made more money because your purchasing power is flat. Now, if your income growth was up 1% last year and inflation's up 2%, your real income has gone down. And that's what you're starting to see happen. And this is a precursor sometimes to these recessionary events, is people's income is stagnating while inflation is going up. So imagine if your income growth last year was 0, you didn't really make more money, and inflation's 8%. Your real purchasing power is down 8%. It means every time I go buy something, the bag of chips feels smaller. The Chipotle burrito that I just got for my wife and my daughter was $48 with drinks, chips, and some guacamole. I'm like, $48 for 3 burritos? How is that possible? You feel it, you kind of know it's there, but it's creeping up through a transportation cost, the gas to get the burritos to the store, the fact they're having to pay people more to come in because they're like, I can't work for $8 an hour anymore. I can't afford to be here. All right, we'll give you 14. That starts to flow into our economy, and it starts to become a little bit painful. And we can see that, certain things like college tuition and fees have continued to outpace inflation, medical care, energy, and things like that. They're different components of CPI. One is housing. And you can see that certain things, like apparel costs have gone down, but housing, CPI is 45.2%, growth since 2000. That means it costs you 45.2% more to live in the same house now in 2021, when this survey was done, versus 2000, right? It costs you 77% more to get the same healthcare. It costs you 145% more to go to the same colleges and tuition. Filling up your car, 68% more. Now, we know this number has now shot up. It's way up here now. You can feel these things over time. And, when you can offset it, because over time, if you're saving, say, $1,000 a year, which doesn't seem like a lot of money, but if I'm saving $1,000 a year and my income's going up by 3% a year, if I just add 3% a year to my savings, I will grow my income in a way that will actually keep pace with inflation. So one of the best things you can do is index your own savings each year to inflation. If inflation's up 3%, save 3% more. If you save $1,000 a year and that's it, you can't save $1,000 a year for 30 years and expect to have the same money buying power. But if you saved $1,030 next year and then $1,066 the next year, by the time you get to the end, you'll maintain your purchasing power because you were indexing your savings to purchasing to the actual value of money over time. And I use an example. This is one I posted some time ago, and people are like, well, I don't really understand what you're saying here. Write a check in future dollars. What I was saying is, if you borrow $100,000 today, and then you went back to the attorney's office that afternoon, and you said, I want to pay off my mortgage, what check would you write? And the answer is $100,000. Now, if you borrowed $100,000, didn't make a payment on it, came back to that attorney's office 30 years later and wrote a check and said, I want to pay off the mortgage now, well, it's still a $100,000 mortgage, but inflation over time has devalued the dollar. You're actually making a payment of about $40,000. So this is one of the biggest misunderstandings about inflation. Inflation stinks from a cash flow standpoint, but it's wonderful if you have debt. because deflation devalues the dollar, which means it's cheaper and cheaper to pay off the debt in real dollars each year. If you borrow $100,000 and pay it off 5 years later, you're paying off $85,873 in real dollars for you at just a 3% inflation rate. Higher inflation rates devalue the dollar even faster. And this is one of the other reasons that borrowing can actually be an incredibly valuable financial strategy for you, because inflation tends to increase house prices while simultaneously decreasing the cost to pay off that debt over time. So the longer you can wait to pay off that debt, the better. This is one of the Dave Ramsey things that I think gets completely missed up, because he's all about psychology and stuff. He says, pay off your mortgage as fast as you can. Well, if you do that, you're missing out on the value of inflation devaluing the debt. And the Fed understands this. They want inflation because it devalues their cost of borrowing over time.
So the hard thing for me on that, Todd, is what about if you're paying 5% interest? At what point, like, what's the break even with what you're going to pay in interest over time versus paying it off earlier? That's what's hard for me to.
Oh, no, it's a wonderful question. And we call it EPR, effective percentage rate. So let's say you're borrowing at 5% right now, Deborah.
Okay.
Okay. And you have an extra dollar. What's your choice? What can you do with that dollar?
Invest it, spend it, save it.
You got to invest it, spend it, save it, or repay debt. Or repay debt, or go to Vegas. That's another strategy, right? Repay debt. So the question is, what's the highest and best use of the dollar? So the question is, if I have an extra dollar and I could spend it, I'm not earning anything now except immediate gratification, and that has value, right? I can save it, and I'm going to earn whatever return I earn on that dollar over time. So the question is, over time, can I earn 2%, 5%, 10% over time? You know, if I look at historical market rates, the last 30 years, the stock market's averaged over 10%. So I can put it in the stock market, and my expectation is I would like to earn, 7, 8, 10% over time by investing in the stock market. But to your question, I could also repay the house debt. If I put $1 into the house and repay the house debt, what am I earning by doing that?
You're not having to pay interest as long.
You're not having to pay how much interest? 5%. So you're earning 5%. Because if I put $1 in the house and my debt goes down by $1, I no longer pay 5% on that dollar. That's the same as earning 5%. So the downside is, the upside is it's a guaranteed return. Anytime I have extra money and I pay down debt I have, if I pay down a credit card debt of 18%, how much to earn on that debt repayment? I'm investing that money and earning 18%. That's why you always want to pay down your highest interest rate first, because I can never earn 18% investing in the market on a guaranteed basis. But if I pay down my credit card debt, I get a guaranteed 18% return. And that is pretty cool. So I always want to pay off highest interest rate debt first, all the way down. And what starts to happen is, what happens when you get down to a mortgage at 5%? And you're like, if I pay that mortgage off, I'm earning 5%. But don't remember, it's not just return, it's safety. Well, I'm putting the bank in a safer position, but not myself. And liquidity, I can't get that dollar back if I really want it, right? So that's when the question becomes, is the dollar best utilized going into the house? Or could I put the dollar in a place that if it just earns 5%, I'm net. So if I put the dollar in an investment account, it earns 5%. I still have safety and liquidity, but my return is at least going to keep pace. It's going to go up 5%, and this is going to keep costing me 5%. It's a net zero game. If I earn 6% in my investment account and I could have paid off the debt, I get the safety, liquidity, and I get an extra percent for my trouble. So that's where a lot of people are like, should I pay off my house? I'm like, if you want to pay off the house, set up a house payoff fund. Put all your extra money that you have in that fund. And the day you pay off the house is when you write a check to pay it off in full. Because at that point, you at least have 100% control of the asset, the house, because it's your house now. Why would you keep paying off a bank house? Because you don't own your house. the bank owns your house. You know, the note, basically the deed says, okay, it's your house, but the note and contract say you don't own it until you pay it off. So I'm a fan of paying it off by writing a check and not until then. And in the interim, having that safety, liquidity, return, that use and control of that money, put it in a side fund. Now, if the mortgage rate's 10% and I can only earn 4% in my investment account, then I'd have to say, nah, I'd put the money in the house potentially just for the return issue, get an equity line of credit, and that gives me liquidity if I need it. Does that make sense?
You explained it perfectly.
So at what age do you think on average folks should really be targeting to be at that call to freedom point where writing the check is just a strategic financial planning decision? Like, and I know it's a personal choice, but like, where do you usually see that land from a planning standpoint?
Yeah, so I'm gonna give you my quick house home pitch here. If you sit there with a couple and you're talking to them, you'll hear the wife using the word home and the husband using the word house. It's embedded and wired in. There's no such thing as a home. A home is an experience you have living in a house. Okay, the house is the physical structure. It's the brick, the mortar, it's the mortgage, it's all that. If it's a logical decision, we're talking about the house, Dave, and I can show you financially, it never makes sense to pay off the house. It becomes a point in time where you say emotionally, this is more about home for me. I'd have a better experience in the house without a mortgage. Now you're making a home decision. You just feel better having the mortgage paid off. You've said the finances don't really matter to me. And in my mind, that can easily trump the house decision. And for some people, it's a point where they have so much money, they don't even want to mess with it anymore. They just are like, I didn't want to have a mortgage, right? Warren Buffett supposedly still has a mortgage. It's a matter of principle to him, and he's talked about that in many articles, right? That's not about money. It's about principle in that concept. But if you emotionally just feel better.
Well, by the way, time out. So Warren Buffett does still have a mortgage, and he talks about that publicly. I didn't.
Oh yeah, there are a couple cool articles out there. There's one where he showed his house. He lives in a simple ranch house, right? And he said he had a $400,000 mortgage. And someone asked him in this interview, why in the world would you have a mortgage? And he's like, well, it's just a matter of principle. If I can borrow money that cheaply over that long a period of time, why would I pay it off? And you're talking about time value of money. I was talking to a CLA yesterday about, paying cash for a house. You pay cash for a $400,000 house. And if you could have invested that money at 10% over 30 years, it would grow to almost $10 million. Wow. If you pay cash for the house and invest the savings, meaning the monthly mortgage payment that you don't have to pay anymore because you paid cash, it would grow to about 8 million over the same time period. That's a $2 million difference on a $400,000 investment. That's 5 times the house price, right? So and why is that? It's compounding time value of money. You've got more money working for you up front, compounding. The monthly payment doesn't catch up with the lump sum in some cases, right? At certain levels of compounding.
Hey, I wanted to make sure y'all saw, and I put a link to it. We actually do have a Warren Buffett versus Dave Ramsey TCA recently. I just put a link to that where it kind of plays that, should I, pay cash for the house, pay it off within 15 years or do the Warren Buffett and invest the difference. So just FYI, you can create your own version of that. That might be another cool news hack, find one of those Warren Buffett articles, reference it. Sean Herrera, if you're hearing this, I have a feeling that would be a fun way for you to also tell the leverage story, is get a Warren Buffett story or slide. If anybody does that in the mortgage coach community, please share that. So Todd, we are out of time.
Yep.
I do want to make sure everyone notices that Deborah did share a number of her of social media slides where she's like showing some of these concepts. This is my personal new favorite, by the way, Deborah, where you're really showing, $5 in coffee over 30 years, what that means.
You know who gave me that idea?
Who's that?
Your Skip the Bagel.
Oh, Skip the Bagel. Yeah.
Yeah, it's similar.
Yeah, we've got a great image in the Mortgage Coach Facebook group on that. Todd, any closing thoughts or remind people where they can go and get these slides?
Yeah, I create a simple domain. It's called calmeducation.com. Calmeducation.com. You can go there. You can see all the courses. You can see promotional material and things. And one of the things, just as a 30-second shout out, the Calm Pen Fin worksheet. Download this spreadsheet and fill it out. It's going to take you through your experience with money. It's going to explain to you the progressive tax system. It's going to give you a way to put in your current expenses just to see what they look like. It's going to allow you to go in and take the stuff that's on a normal application, your front end assets and your liabilities. It's going to map it all for you here. One of my favorite things is it'll tell you how many months you can live without income. It'll take all your income and your expenses and say, hey, based on your income today, based on your savings, you can go 92 months without making $1. And that's kind of cool. But more importantly, it looks at your future self, and you can go through and say, here's what I want to spend in retirement. Here's the money I want to have. This is what's going to come in from Social Security. How am I doing? It'll tell you if you've got a surplus or a shortfall based on your current savings today. And it's a chance to go through, I call it the PenFin Challenge. Challenge yourself to see how are you doing in this little game so far of money. How much of the money that you've made have you been able to keep, and what are the things you can do to make a difference? And sometime we can come back on and just go through this and walk through the worksheet for people, but just download it, fill it out, play around with it, see what questions come up for you. It's not about budgeting, it's about awareness. Create awareness around money, and don't feel like I'm going to go in and do this and feel like I got to do less of this or less of that. That's not, budgeting doesn't work. Just create awareness wherever you can.
So I do want to show one more thing. Todd's been sharing some really just super insightful posts. It's got he's always got a graphic. He always frames it with some really smart narrative. I do want you guys to notice there's a topic here. I add a topic. If you click on that, there's over 22 posts with this insights, and most of them are Todd's. So anytime I see something that I'm like, you know what, that's really valuable insight that I want to make sure this community has access to, I put that tag on it. I do believe y'all can put that tag on things as well, but I just want you guys to be aware that that's another part of the value to the Mortgage Coach Facebook group, is that some of the best content is organized around those tags. So Deborah, close it out for us.
Okay, so like Todd Bookspan would say, you just invested an hour of your time on this call. Now it's time to take action. So the 3 things that I would recommend is to make sure you fill out that worksheet that Todd just shared. Because how can we really be good financial advisors if we're not also a student in financially advising ourselves? Okay, we have to lead ourselves forward and lead other people. The second thing I would do is go to the calmeducation.com site, get some education knowledge under your belt so that you can be giving better advice. Obviously contact Plug and Play SM for us to create that kind of content for you on your social feed. And then the last one is to check out the insights hashtag that Dave just shared, so that, again, have that time in your day, every day time block, even if it's the first 30 minutes where you're helping bringing awareness not only to yourself and one thing that you learn, then go serve more, which is what social is all about, is learn so you can serve. And right here, Dave has made it very easy with this community, and Todd, goodness, I've told you this a million times, the content you have is incredible. So thank you both for hosting this call, and for those of you who took the hour to invest in yourself. Now take action.
All right, guys. So hopefully you got tons of value over the past hour. Please give it a like down below. If you did, share it with your mortgage friends so that we can increase the impact. We can take this no borrower left behind movement, and we can help families get the right mortgage. We can help families build wealth with real estate in the most efficient way possible. And guys, you can't do that by just being a loan officer. Being a loan officer, knowing how to close a loan on time, keeping your promises, having great rates, that is debt. And debt is not the way to financial freedom. Strategic debt, financial planning debt, helping people, know what their goals are, know what their dreams are, and then using a total cost analysis to help them do it. Also, make sure you check out the Certified Liability Advisor, Todd's platform. It's just a great education, so check that out. We did go a little over. Apologies, guys, but we got the professor, and when you got the professor, you gotta go through the lessons. So, Todd, thanks a lot, brother.
Thanks, everybody.
Take care. This is a wrap.
See ya.